What's up, YouTube fam? Welcome back to the channel. In this episode, we're going to talk about the number one trade that people should take but aren't talking about at the moment, at least not yet. So in the moment, we have the meta chart open, but let me move over to the S&P 500. And looking at this chart, right, I know that the last couple months or couple weeks up into a month, right, let's see, what's the date? Starting up until, the beginning of February. So the last month has just been just brutal, right? And we finally started to break out of, this sharp downtrend, right? Because at the end of the day, when you see something this sharp, you have to believe that there is going to be some sort of retracement. And we finally retraced, it finally looked good, and here we are pooping back down. Now, based on these drawings, based on, what seems reasonable, we probably will start off this week at the very least in the red, right? As these zones look like very clean zones that who knows where the S&P is going to tap into. Now, with that being said, when we zoom out, right, and this is kind of the message I've just been trying to get across as much as possible, this is still an extremely, extremely bullish chart, right? So to start switching now and going bearish now, it doesn't make sense, right? Because it's like, think about it in the sense of the live odds are just going to increasingly become more and more bullish, even if the S&P takes us all the way down to 510, which is very possible. Me personally, I don't see us getting all the way down there before coming higher. I could see us just getting here, but at the end of the day, the bottom has to be near, which is why I actually loaded up on more leaps this upcoming week, the last 2 weeks. Now, obviously, these leaps are not in the best position. This one's down 40% because I got in, basically at the very top, but I did just add a second contract. And then this one, I just recently added about a week, 2 weeks ago, but it still has 2 years to, increase in value. And ultimately, when I look at the next 2 years, right, it's hard for me to envision that we're going to spend the next 2 years like this, right? In the end of the day, we're talking about January 2027 for the position I'm in. I have these leaps open until January 2027. And it's even if we do come lower up until here, it's I really just don't see a world where by 2027 we're not at all-time highs. Honestly, even by 2026, we still have a long amount of time for this year, 7-8 months. And realistically, the S&P 500 is not known for just consolidating. It's not known for just sitting in a zone like this and doing this for years, right? It's known, as you see when you look at the chart, right? And that's the cool part about the market. It's yes, the past doesn't always indicate the future, but at the same time, it does in ways always mimic it. And you'll notice how the consolidations are always very, very short. Maybe it doesn't go up super fast, right? Maybe it's a slow growth, but it's never really consolidating. Obviously, lately it's been going up faster than ever, which is why we're also seeing it come down faster than ever. So you can't be surprised by the volatility. Now, looking at individual stocks, to sit here and say Meta doesn't seem like an unbelievable buy, you really can't say that, right? To sit here and say Robinhood, Robinhood, you could honestly wait for it to fill this gap if you really wanted, but Robinhood has always been one of my favorite stocks to get involved in. And right now it's if you love the stock, why wouldn't you love it now, right? You loved it at 65, why wouldn't you love it here at 41? Ultimately, Nvidia, I have started to hear not bad news about Nvidia, but maybe not the greatest news. So it's not something I would be rushing to get into. Shopify still remains one of, if not one of my favorite stocks by far, right? And the reason why I love a stock like Shopify is because, it's very easy to see that there's not much competition. It's a profitable company when we pull up the statements and the financials, which, these are things I talked about a lot when I was trading individual stocks more lately. Let's see, why is it not showing right now? Well, I don't know why it isn't showing me at the moment, but lately I haven't been talking about individual companies as much because the majority of my positions have been TQQQ and IBIT. But ultimately, loving a company should not change in a bear market, right? Let's see, can we pull this up? Nope. So for whatever reason, again, I can't pull up financials, but United Airlines, another company that's just, there's not much not to love, right? You could say, oh, there's not much to love, but in this case, there's just not much not to love. And if anything, we're approaching a very, very strong demand very soon, which is a supply that turned into a demand. And ultimately, the stocks that you loved back when they were at highs, you should be loving now. And that's how you should be treating the market as an investor. Like I said, for me, I'm sticking to UPRO, which mimics the S&P, TQQQ, which mimics the NASDAQ. And obviously, they are getting crushed at the moment. And listen, it could be due for another long bear market like we see here. in which case, yes, I will be down a lot of money technically in the short term, but in the long term, it's not something I'm stressing about because this isn't like, TQQ isn't something I'm worried about going bankrupt. It's not a stock that I'm worried about losing all of my money on. Yes, it might get decay, in which, as you see here, right, it hasn't been able to create a new high. When you pull up the regular NASDAQ chart, you'll notice how, it completely destroyed this high. So yes, there is decay behind TQQ, but at the same time, I do feel comfortable selling options on it, whether it's calls or puts, buying leaps, and just continuously increasing my position, because it is something that I know, when it does bounce, is going to bounce hard. And it's not something, again, that I'm trying to predict or have guesswork. SPXL, UPRO, same concept. And of course, IBIT, one of my favorite, which again, just tracks Bitcoin. So for me, as you know, my strategy is very simple. I'm investing in things that are a little more risky, but at the same time, removing the guesswork, because I don't want to be involved in stocks, individual stocks that might not recover when the entire market does recover. When we pull up the VIX chart, it does look like it continue going up at the moment on the monthly, but at the same time, when VIX goes up, premiums go up. So that's good for option sellers, as now, selling covered calls will be more profitable. Obviously, when we get higher, it's almost an indication that the market is going to reverse, right? When VIX does get up into this supply zone, there's a good chance that the market bottom could be relatively close. So it gets riskier to sell calls as well. And that's the game, right? There's always increased risk when there's increased volatility, which also leads to higher premiums, which makes option selling more appealing. And it's what makes it stressful, right? Imagine you can have high premium with low volatility. It would be phenomenal, but that is not how this game works. And if you haven't learned, you will. So with that being said, of course, our account is in the red, relatively deep, 15, 16% year to date. But at the same time, when you compare it to if we weren't selling options, it would, in the end of the day, it always comes down to the asset, right? You can't say, oh, you're down 15% when the S&P's, only down 8% or whatever. In the end of the day, when you're down, you have to compare it to the stocks that you're trading. And we're down less than Bitcoin. We're down less than TQQ. Let's look at TQQ's year to date, 29%, Let's look at IBIT's year to date, 13%. So we are down a little bit more than IBIT is, but we've also taken a lot of risks that don't involve IBIT. There was positions on Connell, positions on TQQ. So overall, being down 16% at the moment, when one of the assets you're trading is down 30, that's the only thing you can compare it to, because selling options always comes down to the underlying asset. It's like an insurance underwriter. It comes down to what you're insuring. So you can't compare selling options on TQQ to selling options on the S&P. If you were selling options on only the S&P, you probably wouldn't even be down right now on the year. You'd probably be up. But for me, I took higher risk on higher volatile plays, and I still continue to do so. Obviously, I take risks that maybe don't always align with the strategy, but I've had my own reasoning, right? Like this call that I bought, I took it when I felt like the market was bottomed out, and it actually did go up, like up over 100%. For me, I wanted to ride to expiration, but I got in somewhere here. Obviously, at this moment, it was up tremendous. But for me, I was planning on riding it to higher, just higher lengths, right? I'm not going to sit here and say higher highs for the market. But, for me, I have all these covered calls already open. I wanted to take some sort of call option, and that's what I did. So again, for me, comparing my account, I'm not upset with the performance at all. Obviously, I do believe in the long run, it's going to be a lot more profitable than majority of strategies, and overall very profitable for myself. This is, one of those worst case scenarios that you have to just live through, get through, and live to see another day. So hope you guys enjoyed this video. Hope you feel like you got something out of it. Make sure to like, make sure to comment, make sure to subscribe, and I will see you in the next one.